somebody they don't know, a stranger, with the intent of selling it to a third party and profiting financially. Well, that doesn't sound very nice. Well, most states have outlawed this arrangement because it violates the concept of insurable interest. That person doesn't have insurable interest, they're just trying to make some money. Next is an investor-originated life insurance policy, or IOLI. Basically the same thing as a STOLI. You don't have to know the difference, but just know that it also violates the concept of insurable interest. So that's really all you need to know about these two policies, is they violate the concept of insurable interest. All right, we're on a home stretch here for this chapter. We're going to go into elements of a legal contract. We will use the acronym COAL, C-O-A-L. The first is the C here, which is consideration. Now, you learned in an earlier video, the word consideration means something of value that each party promises to the other. For the insured, their consideration or value is paying the premium, but also make sure you know it's the answers on the application. That's important. Okay, because how they represent themselves. So both their premium and the answers on the application. Consideration on the part of the insurer is promising to pay in the event of loss. Next, we have offer, and we're going to do offer and acceptance at the same time. The first offer is made by the applicant by completing the application and paying some premium, making an offer to the insurance company. Acceptance would occur when an underwriter would approve that prepaid application. Next, we have legal purpose. Once you get licensed, please do not go out and write up policies on people that are underage, high, drunk, not mentally competent to understand a contract, or all the above. Okay, they must be of age, not high, not drunk, and they must be mentally competent to understand the contract, or it might not be considered legal in a court of law. And then for life insurance to be considered legal, these two elements have to be there. Both insurable interest, where the policy owner has to have insurable interest in the insured, but then they also have to have the consent of the insured to take out the policy. So both insurable interest and consent must be there.